Importance of insurance in personal and business risk management. Risks are part of everyday life. Risks are defined as chance of something damaging or harmful and unexpected happening which may result in a loss either because of theft of or damage to properties, injuries, illnesses, job loss, or even death. One may not know whether these damaging and harmful events that result in losses will happen or when exactly they might happen, making it hard to prepare and plan for them. You most certainly do not know when you will fall sick, get injured, die, or when your property will get damaged or stolen, making it hard to set aside money for managing these losses as and when they happen. Further, one may not have enough disposable cash to protect from these risks, therefore the only sure and better way to protect oneself from the effects of these risks is by purchasing an insurance cover. What is insurance? Insurance is a means of protection from financial loss in which a person transfers the risk of suffering the said loss to another person, usually referred to as risk carrier, with a promise that in the event of such losses, the risk carrier compensates the person who suffered the loss. It is an agreement where a party guarantees another party compensation in the event of a loss, damage, or injury. It is a form of risk management, primarily used to hedge against the risk of a contingent or uncertain nature. Some risks that may directly affect individuals or businesses include loss or damage to properties, injuries, illnesses, death, and liability to third parties. However, not all risks are insurable. Insurable risks must contain certain conditions that make a risk insurable, i.e., pure risks, or those risks that embody most or all of the main elements of insurable risk. These elements are: loss happening due to chance, definiteness and measurability, statistical predictability, lack of catastrophic exposure, random selection, large loss exposure. By purchasing insurance, one transfers these risks to a professional for better management and in turn is assured of compensation, thus financial safety, security, and peace of mind. Majority of insurance policies are optional, meaning one can choose whether to insure or not. Some insurance policies like motor vehicle insurance are mandatory by law, while others like travel insurance are required for compliance, such as in visa applications. In Kenya, injury insurance policies are not mandatory, but the law requires an employer to pay injured employees and therefore it makes sense to buy injury insurance for protection. All having been said, the only role of any insurance policy is to endeavor to return one back to the position they were in before the loss, also known as indemnity. The only exemption to this rule is found only on injury and life assurance policies that are commonly referred to as benefit policies. Insurance and wealth creation. To accumulate wealth over time, one needs to do just three things. 1. Make money. 2. Save money. 3. Invest money. Making money is by working either as an employee or as a businessperson to earn a living. Savings are from these incomes. One can make a conscious decision to save part of the earnings for the future. Investments are from these savings. From these savings that are done over a period of time, one can invest by acquiring assets such as cars, houses, land, or even building a business. After investments, there is a fourth step, which is to protect these assets against losses arising from various risks. Owning various investments such as properties or a business exposes one to a risk of loss of ownership of these investments attributable to various risks such as theft of, or damage to the properties, injuries or illness of employees, and operational liabilities. These are everyday risks that are contingent on any investment, and the way to avoid such losses is to manage the risks and protect against the losses. Protection takes various forms, however. What it implies is that one makes arrangements for the replacement of properties lost or damaged to ensure life continues as usual. One form of investment protection is insurance. Any investment means money spent to acquire or build something, and any damage to, or loss of it would also mean loss of the money spent to acquire or build it. An example is when one invests in a family house worth 10 million shillings, the maximum probable loss of this asset, either through fire or allied risks, is 10 million shillings. When a financial loss arising from damage to the building occurs, there are three scenarios that can play out. 1. Let the house remain in ruins, which will imply that one loses the house together with the financial investment that has gone into constructing or buying the house. Basically, 10 million shillings gone down the drain, and no family house anymore. 2. Assume the risk, also known as self-insurance, which means that one will have to raise 10 million shillings from savings or loan to rebuild or restore the family house. 3. Purchase an insurance cover, so that in the event of partial or total damage, one will be assured of continuing to own a house worth 10 million shillings, as the insurance company will pay the monies necessary to buy a new house, or rebuild/restore the damaged house back to its original state, all these without having to deplete one's savings, or incur debt through loans to undertake such purchase, restoration or rebuilding. The same scenario applies to any other properties for which one has spent money to acquire. The above illustration shows the importance of protecting an asset. However, the expanded concept of insurance protection includes ensuring that health, income, future, savings, and investments are also protected. Therefore, it is essential that insurance becomes part of the wealth creation journey, as it will ensure that all the investments are protected against financial losses arising from the occurrence of the insured risks. What are the personal insurance covers? Personal insurance covers include, but are not limited to: personal accident insurance, motor vehicle insurance, homeowners or domestic package insurance, health or medical insurance, pensions, travel insurance, ordinary life and group life, last expense covers, etc. Insurance covers and businesses. Just like personal insurance, business insurance also seeks to minimize losses by compensating the business in case of a loss attributable to theft, damage, injury, or death. Whereas risks are basically the same, what differentiates business insurance from personal insurance is its operational practices. Therefore, in addition to protecting assets from theft or damage, and protecting employees from the financial effects of illnesses and injuries, there are other operational risks associated with running a business, which includes, but are not limited to: theft of cash, whether by third parties or employees; liabilities arising from injuries of either employees or members of the public; professional negligence covers, for specialized fields. In Kenya, various insurance providers have designed products meant to comprehensively protect businesses against financial losses associated with various risks. In our next videos, we will go into detail about these covers one by one, noting to mention what they are meant to cover, conditions, warranties, and why you need them.